Most contributions to a partnership are tax-free, cash in, property in, and you usually don't recognize gain or loss. The partnership also doesn't pick up income just because it received property. On the EA exam, the trick is basis. The partner's outside basis and the partnership's inside basis often start with the contributor's adjusted basis, not fair market value. When you contribute property, the partnership's basis in that asset is generally the contributor's adjusted basis. That's carryover basis. Your outside basis in the partnership interest generally starts with what you contributed. Again, typically adjusted basis for property, and your holding period carries over too. So built-in gain doesn't disappear. It's just sitting there waiting for a later taxable event. Non-recognition has some big exceptions. First, the investment company rule. If the partnership would be an investment company if incorporated, contributions can be taxable. Second, the 7-year rule. If contributed property is distributed to a different partner within 7 years, the contributing partner may recognize gain based on the property's built-in gain at contribution. These are classic EA exam gotcha triggers. Now the absurd-sounding one, disguised sales. If you contribute property and then get cash or other property back, the IRS may treat it like you sold the property to the partnership. The exam loves the timing presumption. If the contribution and distribution occur within 2 years, it's presumed a disguised sale unless facts clearly show otherwise. That means taxable gain instead of tax-free contribution treatment. Services are different from property. If you get a capital interest for services, you generally have ordinary income equal to the fair market value of the interest you received. Think of it like being paid for your work. It's commonly treated like a guaranteed payment conceptually, compensation, not a tax-free contribution. On exam questions, watch for the phrase, services in exchange for an interest. After contributions, losses are where people get trapped. There are multiple limitation layers. First is outside basis. You can't deduct losses beyond your basis, and any excess carries forward. Then the at-risk rules. Even if you have basis, you may not be at risk for non-recourse debt. Finally, passive activity loss rules. Even if you're at risk, passive losses may be suspended. Different limits, different forms. Here's the exam-friendly way to separate them. Basis is your investment account in the partnership interest, including certain debt allocations. At-risk is narrower. It generally excludes most non-recourse debt unless you're personally liable. Passive loss is about activity level, not dollars invested. Form 6198 is at risk. Form 8582 is passive losses. If a question asks which form, that's your quick tell. What does the term inside basis mean for a partnership? Is it the partnership's basis in its own assets, or a partner's basis in their partnership interest? Or does it depend on whether the partner is limited or general? Think about what inside is referring to here. Inside basis is the partnership's basis in its own assets. The tempting wrong answer is the partner's basis in their partnership interest, but that's outside basis. On the EA exam, they'll test this vocabulary directly. Inside equals partnership-level asset basis. Outside equals partner-level interest basis. Maya invests $1,000 for a 20% general partnership interest and materially participates. The partnership takes a $500,000 recourse loan and has $100,000 of losses in year 1. What is Maya's ending basis, and is her $20,000 share of loss deductible or not? Think about it and build basis step by step. The correct choice is $20,000 deductible loss and $81,000 ending basis. Maya's share of the recourse debt increases her outside basis by $100,000, so her basis becomes $101,000. Then it's reduced by her $20,000 share of the loss, ending at $81,000. A tempting wrong answer is zero basis, but that ignores the recourse liability allocation.